Good morning. Welcome to your daily solo 401k webinar and Q&A session with my solo 401k financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic is, can you buy real estate in a solo 401k plan? As always, this is your chance to get answers. Use the chat to ask questions on today's topic or anything else. Type them over now so that we can be sure to get to them all. They can be surrounding any topic about self-directed IRAs and solo 401k plans. So let's get started here, and then we'll take a look at questions as they come in. So yes, you can absolutely buy real estate in a solo 401k. In fact, for many self-employed investors, a solo 401k is one of the most powerful retirement vehicles for real estate investing because of higher annual contribution limits, the ability for both spouses to pool their funds within the same solo 401k plan, no unrelated debt finance income tax on leverage real estate, and of course, you've got checkbook control with the right plan structure. So let's break down how it works and why a solo 401k is often more advantageous than a self-directed IRA or even an IRA LLC, also known as a checkbook IRA. So what is a solo 401k plan? Well, a solo 401k is also called a one participant plan, owner only 401k. It's essentially a self-employed plan designed for self-employed individuals. So business owners with no full-time W-2 employees other than their spouse or other owners. Any entity type can sponsor a solo 401k plan, whether a sole proprietorship, limited liability company, S corporation, C corporation, partnership. Even a farmer who files a Schedule F can sponsor a solo 401k. And the solo 401k plan allows you to contribute both as an employee and as an employer. So this dual contribution structure is what makes it so powerful. Now, we often get the question of, why is a solo 401k more powerful than a self-directed IRA when investing in real estate? For one, you can make higher annual contributions with a solo 401k plan than you can with an IRA. So for instance, for a solo 401k for tax year 2025, the overall contribution limit is $70,000, whereas an IRA, it's only $7,000. So one of the biggest advantages of a solo 401k over a self-directed IRA is how much you can contribute each year. So that's a massive difference from a contribution perspective. So the result is you can accumulate capital for real estate investment much faster inside a solo 401k than inside a self-directed IRA. For tax year 2026, the solo 401k annual contribution limit went up by $2,000. It increased from $70,000 to $72,000. And that's not counting the normal catch-up of $8,000. And then there's the super catch-up amount of $11,250 for those who are age 60, 61, 62, or 63 in 2026. It's worth noting that same super catch-up amount is also available for tax year 2025. So both spouses can pool their funds in one solo 401k plan. And this is possible if both spouses work in the same self-employed business. As a result, each spouse can make employee contributions as well as voluntary after-tax solo 401k contributions as part of the mega backdoor Roth strategy. Each spouse can also make employer profit-sharing contributions. And this is possible because they are both employed in the same business, and the business sponsors the solo 401k plan. So both can participate in the same solo 401k plan. By having both spouses participate in the same solo 401k plan, this will allow for faster capital accumulation inside that solo 401k, combined purchasing power, because that solo 401k will be invested in real estate through the same plan, since both spouses are participating in the same plan, and therefore they can buy more and maybe even larger properties. So, for example, a husband and a wife operating as an LLC could potentially contribute $140,000 combined, depending on their earned income from self-employment activity for tax year 2025, creating significant buying power for real estate. So in just 1 year, they can contribute in total $140,000 for tax year 2025, resulting in getting $140,000 in that same solo 401k in just 1 year. So imagine how much you can accumulate in year 2, year 3, and so forth. So essentially, this pooling flexibility is not available in the same way with separate self-directed IRAs. So this slide here is an example of a one participant plan. And then this slide here is an example of a two participant plan. Let's say both spouses are self-employed in the same business. So as you can see, it's just one plan, but each spouse can participate in the same plan because they're both working in the same business. So as an example, the LLC self-employed business would sponsor the plan. Both spouses are working for that business, so they can both contribute to the plan based on their respective net self-employment income. And here, since each spouse will contribute to the plan, each spouse is required to have separate holding accounts within the same plan to track their contributions. So they'll each have a pre-tax holding account, a Roth holding account, and a voluntary after-tax holding account for a total of 6 holding accounts under the plan, 3 separate buckets, aka bank or brokerage accounts for each spouse under the plan. Now, when it comes to buying real estate with the solo 401k, there's also no UDFI tax on leveraged real estate. So this is a major advantage of investing a solo 401k in real estate, is the fact that unrelated debt finance income tax does not apply. What is UDFI? Well, unrelated debt finance income tax is a tax that applies when an IRA uses a non-recourse loan to purchase real estate. If a self-directed IRA uses debt financing, then the UDFI is going to be triggered. And as a result, a portion of the rental income becomes taxable to that self-directed IRA. And you're also going to have to file Form 990T for that self-directed IRA. And then the taxes due resulting from UDFI leverage financing, it's going to be taxed at the trust tax rates. Well, with the solo 401k, again, the solo 401k is exempt from UDFI when investing in real estate using non-recourse financing, which means that no tax on leverage rental income, no tax on leverage gains within that plan, and of course, no Form 990T is required, since the UDFI does not apply to solo 401k plans that invest in real estate. And again, UDFI is when a solo 401k borrows funds from a hard money lender or a bank as a non-recourse loan. The loan is to the solo 401k plan. And then the solo 401k plan uses those borrowed funds to invest in a rental property. So that's a way to get more funds in your plan indirectly so that you can invest in real estate. Now, before we get into the steps to invest in real estate using a solo 401k plan, let's take a look at some questions here. Let's see here. My solo 401k accounts are held through your firm with Fidelity. Does the plan allow me to open another multiple Roth accounts? I'm concerned about reaching the max of the SIPIC limit. Yes. With the solo 401k plan, you can have multiple holding accounts for the same solo 401k plan. So you can have brokerage accounts at one brokerage firm like Fidelity, and then open up additional brokerage accounts at another firm like Charles Schwab. And it's as long as you open those brokerage accounts under the same solo 401k plan, it's still considered just one plan. And as a result, it's not considered separate solo 401k plans, so no separate reporting. Let me share a link from our website that talks more about the SIPC protection for solo 401k plans. I just went ahead and shared that link, and then I'm going to provide a link. So yeah, that's the one I want to provide there, was regarding SIPC protection. So yes, that's possible. You would open up those additional brokerage accounts in the same solo 401k plan name using the same EIN number, resulting in still being considered one plan. Because again, you can have multiple holding accounts for the same solo 401k plan. Some of our clients will have separate bank accounts in the name of the solo 401k plan, and they'll also have separate brokerage accounts in the name of the solo 401k plan. The key is that they are all open under the same solo 401k plan name, using the same plan EIN number, so it doesn't trigger any adverse reporting. Let's see here. I've taken out loans. If I pay the loan back early, will I still have to pay the interest as if I had paid it according to the schedule? No. So you're referring to a solo 401k participant loan. If you pay back the solo 401k participant loan early, you need to review the solo 401k participant loan payment amortization schedule that we prepared. And there's a tab in the bottom of that payment schedule, which is an Excel payment schedule. There's a tab at the bottom where you can click on paying off the loan. It'll list what your payoff is. So no, you cannot pay more interest than what is due at the time of the loan. So good question. Now keep in mind that if you pay a loan back, a solo 401k participant loan early, that 12-month rule still applies, which the IRS instituted to keep individuals from using their solo 401k plan as a piggy bank by processing or churning solo 401k participant loans. For example, if you borrowed $50,000 from your solo 401k plan, which is the maximum you can borrow, and then you pay back early, you're going to have to look at the highest value of that loan during a 12-month period to determine how much more you can borrow, which means you may not be able to borrow any more, or maybe just a small amount because of that 12-month restriction. Let me see if I'm going to share a link from our website that talks about that. It's called the solo 401k loan limits. Let me share that link for those that are processing multiple participant loans or are planning to pay a loan back early. It's important to understand those multiple solo 401k loan restrictions, which are IRS statutory rules. In other words, those are not driven by the plan document, but rather by the statutory IRS code regulations. Let me see if I can share that link. There's that link there. Just take a look at that link there. Let's see if we have some more questions here. Here's a question. I have a defined benefit plan set up for two companies that I have. I made backdoor Roth IRA for $8,600 for 2026. I set up a solo 401k to succeed my old plan. I make the following contribution. Let's see here. W-2 salary, 5,000 per month. Solo 401k employee contribution, 2,708 per month. Health savings account, 364 per month. Voluntary after-tax contribution. Then convert to Roth solo 401k contribution, 3,958 per month. So yes, with the solo 401k plan, if you're doing mega backdoor Roth, if you're trying to utilize the mega backdoor Roth conversion, that's fine. A solo 401k plan is oftentimes open for that reason there. And what's great about the mega backdoor Roth solo 401k plan is that it's not impacted by contributions that you make to your defined benefit plan. Because remember, a defined benefit plan is made up of only employer contributions, not employee contributions. So as a result, even if you max out your defined benefit plan, you're still going to be able to max out your voluntary after-tax solo 401k contribution up to the overall limit, which is $70,000 for tax year 2025, for example. So if you pay yourself at least $70,000 of W-2 wages for tax year 2025, then you can contribute the entire $70,000 as a voluntary after-tax solo 401k contribution and convert it to the Roth solo 401k plan. Of course, if you're contributing to a defined benefit plan, you're going to have more than $70,000 of box 1 W-2 wages. So you're probably going to have plenty of funds to be able to make the voluntary after-tax solo 401k contribution. What is more, the mega backdoor Roth solo 401k plan is not impacted by your IRA contributions, whether you're making non-deductible IRA contributions as part of the backdoor Roth, or whether you're making Roth IRA contributions, or whether you're making traditional IRA contributions. Those never impact your voluntary after-tax solo 401k contributions as part of the mega backdoor Roth. As a matter of fact, we did a webinar a few weeks ago regarding how you can perform what's called the backdoor or the Roth trifecta, where you can do a backdoor Roth IRA, a mega backdoor Roth solo 401k, and a mega backdoor 401k in the same year. Let me share that link with you here. Take a look at this link here. But again, the takeaway here is that your contributions to the solo 401k plan, when we're talking about voluntary after-tax solo 401k contributions, will not be impacted by any contribution that you make to your defined benefit plan or your IRAs for that matter. So take a look at that trifecta blog post we did there along with the live webinar. So good question. Okay, let's continue with our webinar here and then we'll come back and take a look at some more questions here. So again, if this information is helping you feel more confident about your future, please take a second to like and subscribe. It tells the platform that this content is valuable, which helps other solopreneurs like you to find it. So subscribing also guarantees that you get notifications of all the crucial content we deliver every day to help you secure your retirement. So let's keep going here. So let me get back to my slides here. So we're going to, again, today's topic, and we're also answering your questions. We're talking about how can you buy real estate in a solo 401k. So let's talk about the steps to invest in real estate using a solo 401k. So here's how the process typically works. One, you would establish a solo 401k plan. You want to make sure it's a self-directed solo 401k plan, because not all solo 401k plans allow for investing in real estate. So that's step number one. Make sure it's a self-directed solo 401k plan that allows for investing in alternative investments like real estate. And here in my solo 401k financial, we offer such a plan. So you're going to need to adopt a self-directed solo 401k plan. Then you're going to need to open up a bank or brokerage account in the name of the solo 401k plan. And here in my solo 401k financial, we would shepherd you on setting that up. Many of our clients use Fidelity or Schwab to hold their solo 401k funds for the plan that we offer, and they can invest in real estate through that Schwab or Fidelity brokerage account because the plan is with my solo 401k financial. So it's my solo 401k financial plan that allows for investing in real estate. So we'll shepherd you in getting those, what Fidelity and Schwab refers to as non-prototype investment only brokerage accounts. And of course, those brokerage accounts are going to be titled in the name of the solo 401k plan. And if both spouses are participating in that plan, each spouse will have separate holding accounts, aka bank or brokerage accounts, to hold their funds. So once those are set up, then it's time to fund that plan. You'll be able to make contributions to that solo 401k plan based on your earned income from self-employment activity. You can also fund it by rolling over IRAs or former employer plans. There's no limit to the amount that you can transfer from an IRA or a former employer plan. And those transfers / rollovers do not count as solo 401k annual contributions. So you're still going to be able to make annual contributions as well. And then once you have that solo 401k funded, it's time to identify the property that you want to invest in. And once you make that decision, you need to understand that the property must be for investment purposes only, not for personal use. It also cannot be purchased from a disqualified person like you, your spouse, children, and parents, for example. You want to make sure that property is titled correctly. So the buyer on the purchase contract must be the solo 401k plan, listing you as the trustee. So for example, if the name of your solo 401k is XYZ retirement trust, then title to that plan would be XYZ Retirement Trust, comma, John Smith, trustee. That's how title would be taken. Now, all expenses in connection with that real estate property must flow back to the solo 401k plan. So effectively, what that means is that when it's time to fund that investment, the earnest deposit has to come from the 401k. Closing costs come from the 401k. Repairs need to be paid with funds from the 401k. Same thing with rental deposits. Those would flow directly to the 401k. Now, you can also mention, as I mentioned earlier, you can use leverage when investing in real estate through a solo 401k through a non-recourse loan. So if financing is used, the loan is to the solo 401k. It must be non-recourse. And the lender cannot require any personal guarantee. Effectively, only that property that's used, only the property that was purchased with those borrowed funds is the collateral. So if your solo 401k defaults on those loan payments, the bank can only take that property back that was used to buy that, stemming from funds used from the solo 401k to invest in that property. Okay, before we talk about prohibited transactions, which is always important in the context of a self-directed IRA or a solo 401k, let's see if we have any more questions here. Let's see here. Give me a moment here. Where are we here? Yes, the accounts can be held at the same firm. As far as the next question here, let's take a look at your next question here. My solo 401k is currently held at Schwab. How does involving you guys change the mechanics of managing the account? Well, that would be called a restatement, where you restate your existing Schwab solo 401k plan to a solo 401k from my solo 401k financial. And the purpose of that is because you want to be able to take a loan from your solo 401k plan. You want to perform the mega backdoor Roth solo 401k plan strategy, for example, which the Schwab plan does not allow for. And that's called a restatement. And we restate plans from Schwab consistently on a weekly basis, if not more often. Let me share a link from our website that talks more about how to restate an existing Schwab solo 401k to my solo 401k financial, and you're actually going to be able to still use Charles Schwab to hold the solo 401k fund under our plan inside what Schwab refers to as company retirement brokerage accounts. Let me share this link with you here that talks about how that restatement process works. Take a look at that. And that also has a good video that breaks down the entire process as well. Let me get that link over here so you can see it here. So take a look at that link right there. Okay, let's see if we have some more questions here. Now, keep in mind, we'll be going live again here in a few hours. So if we don't get to your questions now, you can log in again and answer your questions here in a couple hours. We go live typically at least once a day, oftentimes twice a day. And today we're going to go live a second time at 1 p.m. Pacific time. Let's see if we have some more questions here. Here's a question here. I made a miscalculation, overfunded my pre-tax by $7,000. What are my options? Of the account with Fidelity, did you make an employer pre-tax contribution or did you make an employee pre-tax contribution? That's the first thing you have to identify, whether you made an excess employer contribution or an excess employee contribution, because they both have separate rules. Also, when did you make that contribution? Did you make it here in 2026 for 2025, or did you make it in 2025 for 2025 or in prior years? So those are things you got to take into account. Okay, let's see here. Give me a moment here. See if we have some more questions here. Here's a question here. I'm 53-year-old. Can I make up to 80,000 through my mega Roth contribution by a Roth 401k after-tax contribution? No, the maximum annual voluntary after-tax solo 401k contribution as part of the mega backdoor Roth is the overall limit. The catch-up contribution can never be applied to the voluntary after-tax solo 401k. Instead, you would apply that directly to the Roth solo 401k bucket. So if you're making contributions for tax year 2025, for example, then let me pull up my slide here. For 2025, you can contribute $70,000 as a voluntary after-tax solo 401k contribution. So to this bucket right here, and then convert it to the Roth solo 401k. And then your catch-up contribution of $8,000, or excuse me, $7,500 if we're talking about tax year 2025. That catch-up contribution, you would deposit that directly to the Roth solo 401k. So just the voluntary after-tax bucket can hold the overall limit, which is $70,000 for tax year 2025, and then you would convert that to the Roth solo 401k. But the catch-up contribution can never be applied to the voluntary after-tax solo 401k. That would instead flow directly to the Roth solo 401k brokerage account. And of course, for 2026, that limit increased to $72,000. So you would contribute $72,000 to the voluntary after-tax solo 401k bucket. And then the catch-up contribution of $8,000, you would contribute that to the Roth solo 401k bucket directly. Once you make that $72,000 voluntary after-tax solo 401k contribution to that voluntary after-tax solo 401k bucket, you need to make sure you immediately convert it to the Roth solo 401k, and then complete our online conversion form once you've converted those funds, so that we collect the necessary information to issue the Form 1099-R to report that mega backdoor Roth. Now, keep in mind, you need to have enough net self-employment income in order to support your contributions, whether voluntary after-tax, employer pre-tax, employee Roth, employee pre-tax, or catch-up. All solo 401k contributions are based on your earned income from self-employment activity. So if you don't have enough self-employment income, then you will not be able to fully maximize the contributions. So again, you need to make sure you have enough net self-employment income to support those contributions. Let's see here. Here's another question. To confirm that the solo 401k employee and employer contribution will not be affected by defined benefit plan backdoor Roth contribution and asset contribution? Not exactly. I'm saying that voluntary after-tax solo 401k contributions are not impacted by contributions that you make to your defined benefit plan. Let me see if I can share a link from our website that talks more about that. So I'm going to share a link with you. However, employer contributions are impacted. If you contribute to a defined benefit plan, then the maximum you can contribute to a solo 401k as an employer profit sharing contribution is 6% of your net self-employment income. Now, employee contributions are also not impacted, but your employer profit sharing contributions are. You can only do 6% instead of 20% if it's a sole proprietorship, or 25% if it's an S corp. Let me share this link here with you that talks more about the defined contribution limits when contributing to a solo 401k, as well as the solo 401k limits. So take a look at that there. Okay, let's see here. So you made your excess contribution in December 2025 for 2025. Was it an employee? So did you make it as a pre-tax did you make it as a profit sharing contribution or as an employee contribution? That excess contribution, we need to know that as well. Here's a question here. So is the employer Roth contribution the voluntary after-tax contribution? No, that's not. That's separate. Voluntary after-tax solo 401k contributions are part of the mega backdoor Roth strategy. Employer Roth solo 401k contributions is a different type of contribution. And when you make that contribution as an employer Roth contribution, you're going to have to turn around and treat it as a taxable in-plan conversion. So make sure to complete our conversion form on our website. You would complete the pre-tax in-plan conversion form for that employer Roth solo 401k contribution, and we would issue the form 1099-R to report that employer Roth solo 401k contribution as being taxable as an in-plan pre-tax conversion on your personal tax return by issuing form 1040. Okay. Okay, you're saying it was, here we go. Yes, that excess contribution was made as an employee contribution. So you're going to have to remove that employee contribution that you made for 2025. You need to remove it by April 15 of this year. And you need to fill out Fidelity's distribution form to have those funds removed. You're going to have to remove the basis and the earnings. There may have been some small earnings that accumulated as a result of that excess contribution. Let me share a page from our website that talks about removing excess contributions. So again, if you made an excess employee contribution, you need to remove it by April 15 of 2026 if you made it for tax year 2025, because it's an employee contribution. And if your funds are held at Fidelity inside a brokerage account, you need to fill out Fidelity's distribution form to have those funds sent back to your business bank account along with any earnings that accumulated. And you're going to have to pay taxes on those earnings that accumulated. Take a look at that link I just shared with you. Okay, let's continue here with our webinar, our topic for today, which again, we're talking about, can you buy real estate in a solo 401k? Let's get back to my slides here. We want to talk about prohibited transactions, which is very important, especially when making alternative investments like real estate through a solo 401k plan. So the IRS prohibited transaction rules apply to solo 401k plans, pretty much like IRAs. So These prohibited transaction regulations are found under Internal Revenue Code Section 4975. So disqualified persons include you, the participant, your spouse, your parents, your grandparents, your children, essentially any entity you control where you have a 50% or more ownership. So you cannot engage in real estate transactions with those individuals. So an example of a prohibited transaction would be if you use the property for personal use, whether for as your personal dwelling or as a vacation property. You also cannot rent it out to your child. That would be prohibited. You also cannot personally perform repairs on that property that's owned by the solo 401k. That would be considered sweat equity. So that's not allowed, even if you don't charge a fee. You also cannot use solo 401k funds to pay personal expenses or reimburse yourself. That's disallowed. So the bottom line is when a solo 401k invests in real estate, you cannot perform any type of sweat equity work on that property. You can manage the property, however, where you're looking for tenants, collecting the rent dues. You just can't receive compensation for doing those managerial functions, which are also considered trustee functions. So the rule is simple. No direct or indirect personal benefit when investing in a solo 401k in real estate. So if a prohibited transaction occurs inside a solo 401k plan, then there can be dire consequences. The entire solo 401k plan could become taxable. Retroactive disqualification may occur, and penalties may also apply as well. So some final thoughts here is that you can absolutely buy real estate in a solo 401k plan. And in many cases, it is more powerful than using a self-directed IRA because you can contribute significantly more money each year. Also, both spouses can pool their funds in that same solo 401k plan. You avoid UDFI tax on leveraged real estate, and you maintain control as the trustee of that solo 401k plan. Of course, strict prohibited transaction rules apply, and proper structuring is critical. So when done correctly, a solo 401k can be one of the most tax efficient vehicles for building long-term real estate wealth in a retirement plan. All right, let's see if we have some more questions here. We're coming towards the end of our webinar, but again, we'll be going live again here in a few hours. Let's see here. So here's a question from Chris. So that it would be more beneficial from a tax point to make an after-tax solo 401k contribution since it would not issue a 1099-R. Well, in both instances, a Form 1099-R applies. It's just that if it's an employer Roth contribution, that's going to be a taxable event. But if it's a voluntary after-tax solo 401k contribution, you don't get a deduction for that contribution. But the flip side is you convert those funds to the Roth solo 401k. So effectively, the voluntary after-tax solo 401k in conjunction with the mega backdoor Roth strategy is used to get more Roth solo 401k funds into your plan indirectly. What is more, voluntary after-tax solo 401k contributions is a dollar for dollar calculation, whereas employer Roth solo 401k contributions is a percentage calculation, which you're going to need to have more taxable W-2 wages if your business is taxed as an S corp in order to maximize your employer Roth solo 401k contributions, whereas with the solo 401k, when you make voluntary after-tax solo 401k contributions, you just need to pay yourself a minimum of $70,000 for tax year 2025, for example, or for tax year 2026, $72,000, and you can contribute that entire amount to the voluntary after-tax solo 401k and convert it to the Roth solo 401k. Okay, so great. We've come to the end of our session. That's it for today's solo 401k session. Thank you so much for investing your time. Your time is valuable. but we think that your retirement future is worth it. If you haven't yet, please like and subscribe to our channel and like us across the various social platforms and help us get the word out to other solopreneurs. We'll be back here again in a few hours with more crucial content. Until then, have a good rest of the day.